This is not financial advice, educational content only. The headline today is the Fed's next rate decision. That's the story everyone's watching. The thing actually moving credit availability is one layer down. And most retail investors have never heard of it. It's a quarterly survey the Federal Reserve publishes called the Senior Loan Officer Opinion Survey on Bank Lending Practices. SLOOS for short. Roughly 80 large domestic banks respond each quarter, telling the Fed whether they're tightening or loosening lending standards and whether their customers are asking for more or fewer loans. When those two answers stack in the same direction across multiple loan categories, historically, something structural is happening in credit well before rate markets reflect it. Let's look at what the survey actually measures and what it has shown in prior cycles. The Federal Reserve's Senior Loan Officer Opinion Survey goes out quarterly to roughly 80 large domestic banks and a smaller number of U.S. branches of foreign banks. Each bank answers a standardized set of questions across two buckets, standards and demand. For standards, respondents indicate whether they've tightened, kept unchanged, or eased the criteria for approving loans compared to 3 months earlier. For demand, they report whether they've seen stronger, roughly unchanged, or weaker demand from borrowers over the same period. The Fed then computes a net percentage, the share of respondents reporting tighter standards minus the share reporting looser, and that net figure is what you focus on. A positive net percentage means more banks are tightening than easing. A negative means the opposite. The survey covers 4 main loan categories: commercial and industrial loans, typically called C&I, commercial real estate or CRE, residential mortgages, and consumer credit, including credit cards and auto loans. Each category gets its own net tightening figure, which is why C&I can be easing at the same time CRE is tightening. The loan books don't move in lockstep, and the Fed's SLOOS release tables present them separately. The SLOOS becomes most informative when multiple categories move in the same direction across consecutive quarters. The Federal Reserve's published releases from late 2022 through 2023 showed exactly that: net tightening on C&I loan standards, net tightening on commercial real estate loan standards, and net tightening on consumer credit card standards appearing in the same quarterly reports. Net C&I tightening for that stretch ran at levels that the Fed's own summaries characterized as a significant net share of respondents. The language in the SLOOS commentary uses significant and moderate to describe net percentage bands. CRE construction and land development loans showed even broader net tightening over the same period. 3 categories, 3 distinct borrower populations: large corporates borrowing for operations, commercial property developers, individual cardholders, all showing the same directional shift simultaneously. When that kind of stacking happens across multiple categories in consecutive quarterly releases, it functions as a credit condition signal independent of what the policy rate alone would imply. That's my read. The Fed's SLOOS release tables publish these figures by category going back decades, so you can verify any historical period directly. The SLOOS data in its current form goes back to the late 1980s, which gives several credit cycles to compare against. In the period preceding the 2001 recession, C&I net tightening rose sharply in the survey releases, reaching levels that had historically coincided with or preceded credit contractions. In the lead-up to and during the 2008-2009 financial crisis, both C&I and CRE net tightening were running at elevated levels in SLOOS releases from 2007 and into 2008. The survey was signaling stress in bank lending behavior before the broader equity market fully incorporated it to prices. In early 2020, tightening spiked rapidly across multiple categories as the COVID-19 shock hit, then reversed quickly as Federal Reserve emergency facilities and Treasury programs injected liquidity at scale. Research on the survey's predictive relationship to the credit cycle, including work by Federal Reserve economists Lown and Morgan examining how SLOOS C&I tightening leads contractions in actual C&I loan growth, has documented that the relationship is real but not mechanically precise. The lead time varies by cycle. The pattern is not a perfect clock, it's a signal with a record worth knowing. The most important thing to understand about reading SLOOS is that standards and demand are separate questions, and most financial commentary collapses them into one number. Banks can tighten standards while demand from borrowers is still strong. They're becoming more selective in an active credit environment, turning away some applicants but not facing an empty pipeline. That's one condition. Banks tightening standards while demand is simultaneously falling, borrowers aren't even asking, is a different condition. The first suggests selectivity, the second is more consistent with a credit contraction in progress. The 2007-2009 period is instructive in the SLOOS data from that cycle. Standards tightened sharply in survey responses from 2007 before loan demand fell as the recession took hold through 2008 and into 2009. Standards led, demand followed. That sequencing matters for how you read any given release. A quarter with net tightening standards and net weakening demand across 2 or 3 categories simultaneously tells a different story than the same net tightening figures accompanied by stable or rising demand. The Fed publishes both series in the same release tables. Reading them together is the minimum required to use the survey correctly. The SLOOS is a survey, not transaction data, and that distinction matters. Banks self-report their behavior, which means the net tightening figure reflects what loan officers say they're doing, not a verified count of rejections or an external audit of approved loan volumes. The roughly 80 large domestic respondents skew toward the largest banks by asset size, which means regional and community banks, which serve a meaningfully different borrower population, particularly in small business and agricultural lending, are underrepresented in the headline figures. The net percentage format also flattens magnitude. A bank that modestly raised minimum credit score thresholds on consumer loans counts the same as one that restructured its entire commercial real estate underwriting criteria. Both report tighter, and the published national results carry no geographic breakdown, which matters because credit conditions in CRE can diverge sharply by market. A single net tightening figure aggregating conditions in New York City, the Sun Belt, and the industrial Midwest blurs real variation. The Federal Reserve regional banks publish their own lending surveys, which add some geographic texture. The national SLOOS figure is a starting point, not the complete picture of credit conditions. Here is where I land. The SLOOS is the closest thing to a structured, quarterly survey of credit gatekeepers that's publicly available and free. Most equity-focused market commentary concentrates on the policy rate and spread levels. Those are price signals for credit. SLOOS is a behavior signal. It tells you how the people who actually approve or decline credit applications are thinking about risk, quarter by quarter, in their own reported responses to the Fed. In credit cycles, lending behavior tends to shift before price signals fully catch up because spread levels are set at the margin by current supply and demand, not by the credit officer who just quietly tightened debt service coverage requirements on a commercial real estate deal last Tuesday. The gap between what the policy rate environment implies about credit availability and what loan officers are actually doing is where credit stress tends to build before it surfaces in visible delinquency data or spread widening. SLOOS measures that gap. That's my read. It's not a recession prediction tool, and I'm not treating it as one. It's a credit conditions tool. That's a different claim, and the distinction between them matters for how seriously you weigh any given quarterly release. Where it becomes useful is in the combination of direction, category breadth, and trend duration. A single quarter of net tightening is noise. 3 or 4 consecutive quarters of stacking tightening across C&I, CRE, and consumer simultaneously is a credit conditions shift worth taking seriously. If you want to use this, here's the practical tool. The Federal Reserve publishes SLOOS results roughly once a quarter, about a month after each quarter closes. When the next release comes out, check 3 things before looking at the headline net percentage: whether standards and demand are moving in the same direction or opposite directions, whether net tightening is concentrated in one loan type or stacking across C&I, CRE, and consumer simultaneously, and whether the current reading is part of a multi-quarter trend or a single quarter spike. That's the frame. This isn't advice, it's a way of looking. I'm Diane, back next briefing.